Hello. Many of us often get confused that we have so many kinds of life insurance policies. Sometimes even when I came to know about life insurance, I also was like in the same situation. Some say ULIP, some say it is term policy, some call it as traditional policy. So many varieties, right? So today, let us understand. I will take you through each and every kind of policy to make you understand thoroughly. And after this, you will never have any kind of confusion as far as life insurance is concerned. This video may take little, lengthy, but yes, if you have to understand everything, my request is to see this video till the end. Let's start with a term plan. Term plan is basically, you can compare this with vehicle insurance. Unfortunately, if anything happens to any accident or any claim happens to your vehicle, then it will be taken care of. But in case, fortunately, if nothing happens, then the premium which you pay will never come back. This is something like that. You can imagine a term plan is. However, after saying this, a term plan, within term plan itself, we have return of premium wala term plan as well. These are the latest developments. Earlier, return of premium was not there. So naturally, when return of premium, if you are choosing, the premium will be slightly higher. And then if unfortunate event doesn't happen after a certain age, say 80, 85, whatever, depends upon policy to policy, on that particular maturity date, whatever premiums which you have paid will come back to you. And in case if you are choosing the first version without return of premium, then the money which you are paying will never come unless and until that unfortunate event doesn't happen. This is about a term plan. Now let's talk about normal investment plans, saving plans. Now you all understand, saving, the difference between saving and investments. Basic difference is when I'm talking about saving, typically, I don't take any kind of risk. And when talk about investments generally will come with, again, two types, with some kind amount of risk and absolutely zero risk, right? So when we talk about absolutely zero risk, those kind of investments are called as debt investments, DEBT. Now debt investments typically do not have any kind of risk. Of course, they give lesser return to you because naturally debt instruments are those instruments where money will be invested into safe bonds. Example is your fixed deposits. So while selecting a life insurance policy also, you can select either a debt kind of investment or a riskier investment which is called as equity. Now difference between equity and debt is something like this. Imagine if you are giving some money to a small shop owner on loan basis, then that kind of investment is called as a debt investment, because whether that shop is making profits or not making profits, since you have given a loan, your loan has to come back with certain amount of along with principal, certain amount of interest also. But in case if you are investing not as a loan, but you are investing into that particular shop, then that is called as equity, because you are also equally responsible for the profits or even the losses. So in case of any loss, then you will also have to bear that loss. That means your investment is not guaranteed. Those kind of investments are called as equities. So typically investment into share bazaar, these are equity. Investment into a fixed deposit, that's a debt. So life insurance policies also come when your investment, when you're talking about investment or a saving kind of plans, you have to decide whether you wanted to take a risk and invest into equities or you want a safer investment, and whereas there is absolutely no risk. So those investments where money goes into debt markets are typically called as traditional policies, because in those days LIC used to have only traditional policies. Over a period of time, unit link insurance plans, which is nothing but your investments into equities, also evolved. And now you can even think of investing money, your hard-earned money, even in share market, that is nothing but ULIPs. However, ULIPs will have certain kind of risk. We will see how to decide, when to decide, how much you have to expose yourself as far as ULIP is concerned in a separate video which I have already made. So there we will understand your risk appetite, how to calculate risk appetite, and accordingly you can decide whether you should first place invest into ULIPs or not. Now coming back to our basic funda for the day, that is the difference between ULIP and a traditional policy is very clear now, right? Now let's talk about a retirement plan. A retirement plan is nothing but a plan which is exclusively meant for your retirement. Now there, a typical retirement plan, which is also called as an annuity plan, generally does not have a life insurance component into it. Because there is no life insurance component into it, all the retirement plans are taxable. When the money comes back to you, it will get added to your income. That means it is a taxable. However, any insurance plan which has got a life insurance component will have tax exemptions at the time of investment, even at the time of taking the money back. However, there are certain terms and conditions which we will discuss in the separate video where I exclusively spoke about at length about the income tax benefits, both while at the time of investing and at the time of taking back your money. So while choosing retirement also, again you have an option to choose between equity and debt, or maybe combination of both. And now let's understand what exactly is a child plan. Child plan typically is taken to ensure that our kids' education and their marriages are taken care of without any problem. You have to understand that inflation is beating us at least by 5% every year. Hope you understand the meaning of inflation. Inflation is nothing but the rising cost of every commodity. Everything is around us is increasing. The price of it is increasing, or in other sense, the value of our currency, our 100 rupees note, is coming down by 5% every year. So if that is the case, whatever I am able to buy today, I will not be able to buy with the same amount, same price after say 5 years, 10 years, 20 years down the line. If our kids are say about 5 to 10 years age, then definitely we will have about 10 years plus. If the age of the child currently is 10 years, then we have another 15 years for to perform her marriage or maybe her higher education, or maybe at least 12 to 15 years. So the price of education and also marriage, both definitely will increase. So keeping inflation in view, we will have to plan, because it's a lot of cost. You will have to send your child in case abroad for higher education, or perform the marriage in the way you want to. Naturally, you will have to plan well in advance. That planning is nothing but child education planning or child marriage planning. For that, you need to understand how much money is required today if you have to perform the same event, and then keeping inflation in view after 10-15 years, how much that money is required. So then you will have to do a reverse calculation and arrive a figure how much you need to invest or save every year so that you can reach that goal. So again, as I was saying, you have got two options. Either you put money into equities and take little risk, or you put money into safe debt instruments. And finally, if you like my videos, please subscribe, share, and put your remarks so that I can come with many such videos for your information and knowledge. Thank you so much.